Hey guys, it is show time. I am really glad to be here tonight. I'm looking forward to this live stream. I think we got a lot to talk about. There's a lot of good stuff going to be happening tonight, so stay with it. It's going to be a really good show. While we kind of get this thing kicked off, there was some big news today. I thought maybe we would go and hit that big news first. That big news, and I'll share my screen here is at least I think I will. Oh, here we go. Let's share this. We'll do it like that. So, sorry guys, I'm trying to find my. I've got 3 monitors going here, and I can't find my cursor. Anyway, I see it. I just don't know how to get it where I want it to go. Anyway, that's embarrassing. Where did it go? There you are. Okay, it's back, guys. Sorry about that. I lost my cursor. So we have Microsoft hitting an all-time high today as Satya Nadella, who's the CEO of Microsoft, has now hired Sam Altman and I forget his first name, but his last name is Brockman, who are the founders of OpenAI. So the question I have for you guys is, what do you think about that? Do you think that this deal with Sam Altman and Brockman are going to really catapult Microsoft further? I don't know. Let's take a look and see what this article says. It says that shares of tech giant hit an all-time high on Monday as Nadella received considerable credit from industry leaders for bringing the OpenAI co-founders Sam Altman and Greg Brockman after last week's surreal occurrences surrounding ChatGPT. I think this is pretty interesting, if nothing else, guys. And when I think about Microsoft, I look at the things that they do, and I'm just amazed at the decisions that they make as a management team. So, I don't know. What do you guys think? You think this is a good deal for Microsoft? Do you think it's really just hype? Let me know in the comments what you think about this. And while we do that, we'll go ahead and move on to, let's see, we got Kevin Rayberg in the stream tonight. Bowl of popcorn. Oh, let me just click on it. There we go. Bowl of popcorn, check. Can of beer, double check. Absolutely. And we got Thomas Roach. Welcome, Thomas. Homemade kombucha. Some people call it kombucha, but I'm not sure which one's right. But my wife calls it kombucha, so that's what we call it here at the house. So it's great to have you guys on the stream tonight. So I'm going to stop sharing this particular article, and then let's move on. And I'm going to share this presentation that we have. So tonight we're going to talk about a payout ratio. Now, payout ratio is important. So why am I doing this series of metrics? Because as dividend growth investors, our job is to understand what we are looking at, what numbers we need to look at, what they mean to us. Because, we can look at what other people are looking at, but it may not apply to our portfolio, to our goals, to our desires. So it's important for us to understand these metrics so that we can make our own decision about what we want those metrics to look like. And this one in particular is going to be kind of interesting because there are a lot of factors related to the payout ratio. So, and I've titled it Dividend Gold, Unveiling Winning Metrics. This week is the payout ratio. So let's take a look at the payout ratio. What's important to understand when we're looking at the payout ratio is to understand what it's really talking about. And we can't do that unless we really look at what are the sources of capital for a company and what are its uses. So sources of capital, and you guys will mostly already know this, but it's kind of hard to understand, in the audience, what level of knowledge people have. So I want to start here tonight and talk about the sources of capital. One is the cash from operations. So the company sells goods, they buy products that they make into that, they pay salaries, they depreciate assets, and all of that kind of happens. And at the end of the day, they have a cash flow from operations. So that is one source of capital. Obviously, there's a lot of tentacles to that. But for tonight, let's just consider all of that one thing. Then they can also issue debt, which we know because that's one of the things we like to look at. And then they can issue stock. So when they issue stock, they get cash from the equity market. So you have the business, you have the debt market, and you have the equity market. Those are really three major areas for sources of capital. There's probably more, but for tonight's discussion, let's leave it with that. Then we move on to, so what then do they do with that capital? So when we think about how they can use that capital, we can look at that they can invest in property, plant, and equipment. They can, like for instance, if they want to make, if they want to increase capacity in their manufacturing plant, they can buy either a new machine or additional machines. They can buy vehicles. They can buy any kind of property, plant, and equipment. So that would be one use of their capital. Another use of the capital would be if they wanted to buy a company. So if they wanted to merge with a company and actually buy shares of that company, that'd be another use. They can also pay down debt. They can pay dividends, and they can buy back shares. There's a few other little ones, but for tonight, let's focus on these. And so where does the payout ratio fit in all of this? Here's the big point. It actually will measure, where how much dividends are paid based on the earnings of the company. So before we kind of get too far in depth in that, let's look at the formula. As we always do, we're looking at formulas because they are metrics, they're calculations. So what are they calculated with? This I've added a little bit of a disclaimer on here, not a disclaimer, but a clarifier. And I've added the word earnings, and I'll talk about that in a few minutes. But the payout ratio formula is total dividends divided by net income. And and if you wanted to look at it on a per share basis, it is the dividends per share divided by earnings per share. So these numbers would actually calculate to the same answer. But there's one really important thing to remember here. So pay attention to this. The earnings payout ratio is typically used with adjusted earnings. So as many of you will know, most companies have what they call adjusted or normalized earnings. Now, what those earnings are, or what they believe investors should look at for a continuing, a forward-looking view of the company. So they will ignore things in the adjusted earnings. Like, here's an example. They will ignore currency translation. So if there's either a big gain or a big loss from the exchange of currency at the time their financial statements were done, they will kind of ignore that and consider the net of that, the adjusted earnings. And so if you ask me, is that a good practice? I think it is. I think it's important to understand what those differences are between GAAP earnings and adjusted earnings. But what's most important for tonight is that you understand that they don't use typically GAAP earnings when they do the payout ratio. They will use the adjusted earnings. That's very important to keep in mind. There's also another payout ratio, and it is called the free cash flow payout ratio. And I've adjusted the ratio slide here a little bit. Just did some scratching out. And then the free cash flow payout ratio basically takes the dividends divided by free cash flow. What is free cash flow? Remember from our slide earlier, it is cash from operations less capital expenditures. So it is basically the capital that's left after running the business and after investing in the business. So it's the total dividends divided by free cash flow, or you could even do it per share and say dividends per share divided by free cash flow per share. Both of those get you to the same number. So why does this matter? I'm going to show a few things here. I'm going to show a few companies And there is a metric, or this payout ratio has a standard percentage that some people will use, and that is 60%. So you'll typically hear, especially on YouTube, you'll hear investors say, well, I'm looking for anything less than 60%. And that's pretty standard, not only on YouTube, but really from everywhere. So so if I look at Microsoft, and hopefully you can see this, I may try to blow this up a little bit. Is that better? Can you see that better? So the earnings payout ratio for Microsoft, and I'll move up a little bit so you can see. This is Microsoft, and even Simply Safe Dividend says, hey, our preference is to be below 60%, and I've underlined for most companies. So that is a good kind of gauge, good standard to go by, is 60% or less. Interesting, Microsoft is down around 27%. You see that last 12 months is 27%. They're predicting the next 12 months to be 27%. I thought it would be interesting to also throw IBM in here as well. IBM is also considered most companies. So they're looking for about a 60% there, but IBM's a little higher than that. It got up to 83 in 2021, which means that in 2021, IBM was paying out 83% of the company's earnings to shareholders in the form of a dividend. So that has improved some. It is now down to 71 over the last 12 months. And they're predicting it'll be 69. So they're on the right track. But I wanted to show the difference between two kind of techie companies, one being very low at 27%, one being actually pretty high in the 70s. So normal is about 60. But the question is every company, should we consider every company that way, or every industry that way? And the answer is no. Let me move on here to Pepsi, and you'll see that Pepsi is in the consumer staples group, and Simply Safe Dividend says, hey, anything below 70 in consumer staples, we prefer. So they're looking at 70. Now, Pepsi, I used to own Pepsi, and when I look at the earnings payout ratio, they are improving. They're getting better. I was more concerned with Pepsi's free cash payout ratio, and I'm on the wrong slide here, wrong screen to move this around. So let's do that. So you can see the free cash flow payout ratio for Pepsi was like 111% in 2022. That means that Pepsi paid dividends more than the free cash flow generated by the company. I was a little concerned about that. It has come down in the last 12 months. It's only 96%. So all of their cash flow is going to dividends. Anything that they're doing for capital investment is really coming from debt. Now, I will say this, it is good to see that Pepsi is going down to around 75% in the next 12 months. So happy to see that for Pepsi. It's that's a good thing for them. But I thought it'd be interesting to also compare them to Coca-Cola. So we have 64% for Pepsi. When I scroll down here to Coca-Cola, they're around 69%. So not actually too far different. And Coca-Cola had a similar issue. Gosh, that was back, I guess, 2017 timeframe. Now they're in the mid 70s, still high from my perspective. And so now, just for clarity, I don't own either Coke or Pepsi. But I thought it'd be interesting to show that the consumer staples has a standard of around 70%, not 60%. Now we're going to look at utilities. So utilities are different. They're a different animal. I'm not going to talk about utilities because my career was in the utility industry, so I can really bore you to tears with details around the utilities. So I'm going to try to stay away from that. But you'll see that Simply Safe Dividend prefers 75% for utilities. So remember, standard is 60. The consumer staples was 70. Utilities are 75%. And this actually is a utility called WEC Energy. It's out of Wisconsin. And utilities, just so you know, I got this big red X on the free cash flow payout ratio. It is really not helpful to look at the free cash flow payout ratio for utilities just because of their business model. If you want me to do a video on that sometime, I will, but I'm going to leave it at that. So don't really get too worried about the free cash flow rate payout ratio for utilities. Look at the earnings payout ratio for them. And again, below 75 is kind of worthwhile. I thought it'd be interesting to compare them to Southern Company. So Southern Company, again, the target is 75, and they're doing pretty decent. They're in the low 70s. They did have a bump up in this last 12 months. I'm not really sure what that was about because I don't invest in Southern Company. So then it'd be good to look at REITs, right? So let's take a look at REITs. Now, REITs don't use earnings. They use something called an adjusted FFO payout ratio, adjusted funds from operations payout ratio. I'm not going to get into the details of that, but I do want to point out that the standard for REITs is 90%. So if you see a REIT below 90%, that's actually pretty good. So remember, the first one was 60%. So then if you didn't really think about a different segment, and you saw a REIT like DLR, that would be Digital Realty Trust, coming in at 84%, you would go, wow, that is just way too high. But for a REIT, because of their tax structure and that kind of thing, they pay out a lot of their earnings. And so below 90% for REITs is good. You can see what Digital Realties is. I thought it'd be cool to compare that to Kilroy Realty. This is really for my buddy Ryan. So adjusted payout ratio is actually very good. I mean, if you look at this is for the last 12 months, they're down around 54%. So if REITs are targeted at 90% or below, 54% is really low for a REIT. So that makes that kind of worthwhile to me. That's one of the reasons that I have invested in Kilroy Realty. Then I thought it would be interesting to look at BDCs. These are business development companies, totally different industry. And these are slated to be around as a standard 95%. Again, their tax structure kind of requires this. But if they're 95% or below, they're considered good. I invest in one BDC. It is Main Street Capital Corp. You can see here that their earnings payout ratio. Oh, and I forgot to mention this, that on none of these, like utilities, even the REITs, the free cash flow payout ratio doesn't work. For Main Street Capital, the BDCs, the free cash flow payout ratio does not work. So you want to use earnings payout ratio for these guys. But look at Main Street Capital, last 12 months, down around, what would that be? 67% earnings payout ratio, which is really good. I thought I'd compare it to Ares Capital, ARCC ticker, and they're around 81%. Also a very good BDC. It's one, if I wanted to invest in two of them, this would be my second choice. So now I got to really boil this back down again. Oh my goodness. Oh, that's the wrong way. Here we go. So can we boil it down? Yeah, let's boil it down to two things. So all of that to really end up here measures the measures of payout ratio. It measures the percentage of earnings or free cash flow paid back to shareholders. That's really its intent. And it is not a one size fits all metric. Most are 60%, but remember, utilities, REITs, BDCs, and there's another one that I've lost in my head here, but all of those are different. So it depends on the industry, and it depends on the investor. So if you are looking for companies that are paying higher income, maybe focusing less on future growth, you're going to be okay with some higher payout ratios because that's what you want. If you're looking for lower dividends and moving forward, you're wanting to have more growth, then you really want to have lower payout ratios. So that'd be the way to kind of think about this. And so there you go. That's our little primer on payout ratios. It's one of the primary metrics that I use You guys will recall I have 5 pillars that I look at. I'm trying to get my hand in the camera. I have 5 pillars that I look at. One of those is capital allocation. How does the company allocate its capital? And do I think it is an effective and efficient way of doing that? It doesn't mean that I want them to allocate that all out to me. I want them to be smart about, balancing, giving money to the shareholders and also investing for growth. So those are my thoughts on that. So let me kind of pop back in here to the, I'm going to remove this, pop back in here and see what you guys are talking about. So we've got Michael Swami in the house. And yeah, Michael says Microsoft scored a coup, and you are exactly right, my friend. Scored a coup. I don't know, man. It's I really questioned today whether I shouldn't buy more Microsoft. So let me I'm going to share something with you guys. I got to pull it up here. I was not planning to do this, but I think it would be kind of fun. So let's do it. We're going to go here, and I'm going to show you my portfolio, and I'm going to do it. I have a composition tab, so it shows, if you can see this, it is the weighting of my portfolio, meaning here, I'm going to make it bigger, meaning what are my largest, right? And I have VU, which is the Vanguard S&P 500 ETF. It's a little less than 30% of my portfolio. I do that because there's a part of my portfolio that I have just for future growth, and so the VU's a great place for me to do that with. But then if you look, Microsoft, as of today, became the largest holding in my portfolio as far as individual stocks go. But that's not the cool part. The cool part is this. I want to show you this. This is in Morningstar's app, and it is really cool. There is a toolbar here, and it does an X-ray thing, and it has a tab called Stock Intersection. So let me just kind of say up front, I don't have an affiliate agreement with Morningstar. I just really like the app, so I'm just showing you this because I really like it, not because I have an affiliate link or anything. So if I look at this Stock Intersection, what it does is it takes any stock that is in my portfolio and it adds the appropriate percentage of any ETFs that it falls in. So here's an example. I'm going to make this a little bigger as well. I have Microsoft. We saw that it was 4.46% of the portfolio. In VU, in Vanguard S&P 500, Microsoft has a place in there. Obviously, it's one of the top 2 stocks in the S&P 500, so it's got a big amount in there. This will tell me that my total portfolio is exposed to 6.5% of Microsoft, not just the 4.46% that I own, because it is also included in the S&P 500 ETF. So that to me is pretty cool. Hopefully that was helpful for you guys. So let's get that off the screen now. So thanks for bringing that up, Michael. I appreciate that. I'm really considering whether I should buy some more Microsoft, but it's already the largest individual stock in my portfolio, so I'm not really sure. Okay, Phil B says, hi. Hey, Phil, welcome to the broadcast, my friend. We have Miguel. He says, good night, and it is good night. It is good evening. It's raining here in Alabama, so hopefully we don't lose power. And if we do, if the screen goes black, you'll know what happened. So we got Lucas Orr is in the house. Hey, Lucas, what's happening, my friends? Good to see you. Derek Pickard. Hey, Kevin. Hey, Derek. What's going on, my friend? Pat says he's sorry he's late, but Pat, better late than never, my friend. Welcome to the broadcast. Tutomi is in the house. Great to see you. So Alagos, maybe I said that right. Hopefully I said it. Alagos says, what do you do when you have a position that is up by a lot and the portfolio weight is low? Do you add anyways, or do you leave it? dividend investing. And I think what you mean there is just have the dividends continue to grow the holdings. That is a great question. It's one that I think we all struggle with. I'll tell you where I kind of fall on that. I sometimes will add to a stock. Sometimes I will hold my nose and add to a stock. It really depends on what its intrinsic value, what I believe it to be, is its intrinsic value. If it has a value of 100 and the stock is trading at 60 and I bought it at 50 and it's on a run, I might buy some more. If the stock is valued at 100 and it's trading at 150 and it's got it's way overvalued, I typically will not buy anymore at that moment. So that's kind of the way I look at it. Hopefully that's helpful, and hopefully it makes sense. But that's the way I look at it. A great example for me is ticker symbol PH, which is Parker Hannifin. I bought Parker Hannifin probably, I don't know, 9 months, maybe a year ago, something like that. And I paid about around $275. Let's say it's somewhere in there for Parker Hannifin. When Parker Hannifin got to be $325, I listened to their earnings call and I was like, this company is doing well. I'm going to go ahead and buy some more of that. I bought some at $325, made my average cost $300. The stock roared up above $400. And then it dropped again back into, I think, $368 or so. And just before this past earnings call, I added some more shares of Parker Hannifin. So I'm actually increasing my average cost, but it is a stock that is really tearing. And let's see, I'm going to go ahead and share my screen again. We will do this and that. And let's go to, where can we go? Let's go to tip ranks and let's look at Parker Hannifin. PH. It closed today at $431. I mean, it is really, really doing well. My purchase price, my average cost is around $326 according to this. I have 75 shares. So hopefully, Alagos, that answers the question. I think every stock is different, and so we have to kind of look at it that way. But if you've got a stock that you believe is trading below its intrinsic value, it might be worthwhile to pick some more shares up. If it's really trading hot and it's above its fair value, maybe not so much. So hopefully that helps. Jim, Tyson has an ugly payout ratio. yeah, 144% is pretty high, my friend. And for a short period of time, a company can do that. Dividends are not being really paid out of the current earnings. They're really more about what the company believes about the future. But that's 144% is pretty ugly. Let's see. Oh, so here we go. Totomi wants to know, can I check the payout for ELV, please, and share what you think about this company? Well, let me pull it up. I guess I shouldn't stop presenting that. Here we go. Okay, here we go. We are going to go to one of my favorite places to get a kind of a snapshot of everything is Simply Safe Dividends. And again, I'm going to make it bigger so you can see it. So let's look up, so if I can find it, ELV. I think we talked about this one last week, Elevance Health. It has a dividend safety of 99, very good dividend safety. I'm going to move your comment off here so we can see. And let's move down and their payout ratio. Let's move down to the graphs because they're easier to see. Their earnings payout ratio is 17%. So, it's very good. Their free cash flow payout ratio is also around 17%. And one way to think about that is that they have very little in terms of, normalized earnings, or, they don't have a lot of earnings stuff that they exclude. So their earnings per share are up and to the right. Their free cash flow per share is doing well. When I look at their shares outstanding, they are doing some buybacks, and that looks pretty cool. They have their sales. Look at their sales, guys, up and to the right. That's really incredible. Return on invested capital is around 14%. They're not lighting the world on fire there. If I think about their cost of capital being 10 to 12%, they are obviously making a margin there, but it's not, lighting the world on fire. I don't typically look at return on equity because of all the shenanigans that kind of go on in the equity area of the balance sheet. So the other thing I look for is debt. They have no net debt, so can't ask for any more than that. They do have debt. So when you see an interest coverage ratio, it means they have debt, and it calculates what their earnings, how many years their earnings would cover. But when they have no net debt, that means they have enough cash on their balance sheet that if they wanted to, they could pay their debt off completely today. So that's the way to think about that. So, based on that, let me take a look real quick at what their I'm going to look at their intrinsic value from Morningstar's perspective and view the full report. And we have a lot of visitors at our house tonight, so I think our internet is really being taxed. But obviously that's not where I want to be. Where do I want to be? I want to go back. Why am I not seeing the entrance? Oh, here it is. It's on the right. I was looking on the left. So it's on the right. They're saying their fair value is 520. They're currently trading around 465. So, based on what I'm seeing, and, just so you know, I don't just, jump into a stock based on the numbers. I want to listen to their CEO talk. I want to hear their earnings call. I want to understand what their strategy is and how well I believe that they could actually acquire that strategy. So, but based on what I see, I think this looks pretty good. So, it's certainly something to look forward to. Let's see, what do we have? So Tutomi, I think ELV is certainly worth looking into. So if it were me. My friend Russ, put yourself in the lower left. More real estate to show the viewers. Hey, thanks, buddy. Let me something like that, maybe. It's good to have people who know this software, and they can give you some tips as we are kind of on the fly here, and it is what it is on the live stream. Can't edit this out, right? So thank you, my friend. So Derek was planning to take some Microsoft profits today and bring their weight back into check, then saw the news. Now what to do? ? I agree, my friend. I'm certainly not taking any Microsoft off the table. My question is, do I want to put any more on the table? Again, it is the largest individual stock holding in my portfolio. It's a good question. So Russ says, that's really cool. I didn't know that Morningstar did that. Very helpful, including the ETFs. Yes, sir. Absolutely. It's a good way to know that you're not over allocated to a stock. When you have a lot of ETFs, a lot of times it's hard to keep track of what those things are invested in. And so I find that to be a really helpful piece of that tool. We have Clayton Mayberg in the house. Mayherg in the house. I think I'm saying that right. So correct me if I'm wrong, but it's hard because I can't hear you. So Pat says, hey, Russ, it's good to have Russ in the live stream tonight. So Fast Eddie, do you decide what's overvalue and undervalue, or do you go by Morningstar or somebody else? That's a great question, and I have typically I have recently begun to rely a lot on Morningstar's valuation, and here's why. Morningstar doesn't simply take the historical numbers and calculate out what they think the if they carry out those same numbers and discount it into the future. Here's what the number is. Alpha Spread would do something like that. It's really more of a, just a quantitative analysis. What Microsoft does is it has analysts who will actually analyze the stock, and they will build a value from the ground up. They may actually do a discounted cash flow analysis, or they may do a sum of the parts analysis. They may do some kind of relative values, but they're doing something that a person who understands that business believes is a good way to value that business. I'm not really sure that I could spend enough time with any individual stock or with all of my individual stocks to do that. So I do rely on Morningstar. If there's something that looks out of whack to me, I will compare it to other things, but I don't calculate my own numbers anymore because life's too short and there's a lot of information out there. So I rely a lot on Morningstar. All right, so let's move on here. Eli's in the house. Welcome to the program, Eli. It's good to see you. So Miguel wants to know about Movado Group. I don't think I've ever heard of Movado Group. So let's look that up. And again, my favorite spot is Simply Safe Dividends. So we'll look at Movado Group. MOV is the ticker. And they have a dividend yield of 4.78%, but they're unrated. So Simply Safe Dividends doesn't cover them. Who are they? They design, source, market, and distribute watches worldwide. I know my buddy Ryan loves watches. I've got a son who loves watches, and it's a fashion accessory. I get that. I'm not very fashionable, so I'm not interested in fashion kind of stuff, but I do know there are a lot who are, and so it might be worthwhile. But I do know that, and we can look at some of the rest of this here. I'll remove your comment just so you can see better. We'll kind of look at some of the rest of these numbers for you. So we have, I passed it. Earnings payout ratios are actually not too bad, but they do move around a lot. What that tells me is that there is a lot of volatility in their earnings. You can also see huge volatility in their payout ratio for free cash flow. So I think the same thing there. There's just a little bit too much volatility in these numbers for my personal liking. But if it's something that you like, if it's an industry and a business that you really are interested in, certainly I don't see any red flags. I mean, they have no net debt and their interest coverage ratio is like 160. So they're definitely a solid company. I just don't know that, from my perspective, I really like less volatility. So that's kind of my thoughts on that. Okay, so Mayherg. Clayton says that's correct. So that's great. Billy's in the house. He says good morning because he is on the other side of the world. He just got to the airport going back home to the Philippines. So glad to have you on the stream this morning for you, Billy. And it's always good to have you, my friend. So Derek says, I bet Ryan knows Movado. He loves watches. Absolutely. He is a watch guy. And, that's really cool. I mean, everybody's got their stuff, right? And watches look cool to me. It's just not my thing. So, I raise chickens, right? So I don't wear watches. Hi, this is Maurik 131. Hi, what do you think of BE Semiconductor Industry? BE Semiconductor Industry. Maybe I'll look up that ticker symbol and see if it rings a bell. But let's check out BE. That's Bloom Energy Corp. I'm not really tracking with you, Marique. If you can give me more, I'm not sure what BE Semiconductor Industry is. So yeah, I'm a little stumped. So maybe if you can give me a ticker, or if you're asking about the semiconductor industry in general, I can certainly give you some thoughts on that. But let me know what you're thinking there, my friend. Jim, Morningstar gives MOV 4 stars, a buy per tip ranks, but not enough analysts covering the stock for my liking. Yep, that makes a lot of sense. And 4 stars for Morningstar means that they believe it's a little bit undervalued. So that's good. My buddy Russ says Movado has insider ownership of 32%. That's not a bad thing. When you got a lot of insiders who own the company, they're typically not going to unload those shares. So that's actually a pretty nice thing. Must mean it's also a pretty small cap company as well. So I'm going to take a sip here. All right, Fast Eddie. How do you figure the COVID years in when valuing a company? I don't really look at the COVID years. I think, when we were in the middle of that, it was really helpful to see where they were before COVID, where they were after COVID, to kind of see the longer term trend. But again, we're not really investing in the past. We're investing in the future. And so when I think about the future, if I'm building the future off of the past, then I have to kind of factor that in. But if I'm building the future off of what I think the business is going to do from here, then I don't really factor that in too much, unless there's something about. Here's where I might, like for instance, Lowe's and Home Depot, if they had a lot of pull forward business, then that might play a factor in that. But so if there's something specific with COVID that drove their business, Campbell's Soup, for instance, is another one, then I would. But I don't think about the COVID years too much. Maybe that's wrong, but that's the way I do it. We got Russ here. Sometimes lack of analyst coverage can be a hidden gem. Yes, it can. It can absolutely be that. But I would suggest that you spend a lot of time with due diligence. And make sure that you know what you're getting. Make sure that you have found a diamond in the rough, not just something that looks like a diamond. We don't want fool's gold, my friend. We want real gold. All right. Bessie Short. So let me pull that up. This is we're looking for BE Semiconductor Industry. Let me see. Bessie. Oh, there it is. BESIY. Wow, it didn't pull up for some reason. Okay, so it does say BE Semiconductor Industries. That's really awesome. There is no dividend safety score, meaning that SimpliSafe Dividend doesn't track them. They are a foreign company. So from a U.S. perspective, I would have to look up where they're from. But, any U.S. investors would likely be paying taxes on their dividends plus taxes on the dividends when it comes in. And then you would have to file to get that back. So I'm just looking real quick to see if I can see it. But, the Netherlands. So maybe it's not so bad. I don't think the Netherlands has, I think they have a tax treaty with the U.S. So maybe that's not so bad. But their dividend growth doesn't look so good to me, my friend. Look at the last full year. They dropped their dividend by 14%. The last 5 years averaged a 4% growth. But look at normally you would expect earnings to be cyclical. I don't really like cyclical dividends so much. And you can see that this is very cyclical, up and down, up and down. It's not my style. So, maybe your style, but certainly not mine. So not something that I would look forward to researching anymore. Jim, that makes two of us, buddy. A lot of times when we get our age, we can afford to be a little lazy and let other people do the work. So let's see, my friend Russ. Great point, Kevin. It does require much more analysis on our part. Absolutely, my friend. And that's kind of what we're here for, right? I mean that's why you're in this live stream, is because you're not necessarily looking for me to tell you what stocks to buy. You're wanting to understand more about how to look at stocks and how to think about stocks. And all of us will do it differently, and you wouldn't do it like I do, but I share with you what I do so that maybe you can get some things from what I do. And I always like to say, maybe you'll see things you don't like, but either way, it's a win, right? Because you know either what you would like to add to your process or what you definitely don't want to add. And so those are both valuable points. Okay, Terry. Terry says, what are the top 3 most undervalued dividend growth stocks in the market right now, in your opinion? Well, that is a great question. And what I will do is I will share with you, I don't know about the whole market because, as you know, there's, I think 12,000 individual stocks, not to mention the ETFs and all that stuff, but individual stocks in the market. So I'm not really sure what the most undervalued in the market is, but I will show you what I believe the most undervalued in my portfolio is. So if I go over here to Morningstar, you can see this. Now I got to figure out how to get to my portfolio. I'm going to back it up a little bit. And it's running a little slow. I guess I got to kick all of our guests out. Here we go. Okay, so if I look at the valuation tab for my portfolio, and I'm going to have to get rid of me altogether, I think, on this one. So let me go over here and do that. I'm gone. Terry, you're gone. So now I think we can see it better. What this does is it takes the current price of the stock divided by what Morningstar has calculated as its fair value. So that means that if it's below 1, it means that the price is less than its fair value. If it's above 1, that means the price is more than its fair value. So the lower the decimal is, the more undervalued it is. And according to Morningstar, my most undervalued stock is Kilroy Realty. So I have a cost per share of $29.99, and it is currently trading around $31. So I have a target buy here of 30. All that does is just alerts me when it gets to that point. Doesn't mean I'm going to buy it at 30. It just means I want to know if it's come back down to 30, so I can start keeping an eye on it. And it basically is saying that the Morningstar fair value is 63, with it being at 30, almost $31. It's saying that it is over 50% undervalued. It is, according to Morningstar, less than half of its intrinsic value. So, it's worth, for me, it's worth sticking a few dollars in. We saw its payout ratios earlier. It looks pretty decent. They're dealing with this issue of commercial real estate, but I believe that they've done some things that will cause them to be the better performer in that REIT space. So, so I'm comfortable with that, and it's worthwhile to buy it when it's on sale like this. Medtronic is another one. It is 33% undervalued. Do you see how I did that? There's a 0.67. 1.0 would mean the price and the fair value are exactly the same. So 1 minus 0.67 means that this is 33% undervalued. I do have a few shares of Medtronic, but I'm not buying any more at the moment. I need to spend a little time with them before I do with that. Realty Income is another one. And then RTX Corp would be the top 4. Now, it also has Whirlpool, but you'll notice there is a Q there. That means that they have a quantitative rating on Whirlpool, a quantitative fair value. I put a lot less weight on that than I do the others, because it's no different than what you would find on alpha spread and those kind of things, where they just basically calculate it based on numbers rather than having a person who goes through and calculates it. And here's a good one. This is one that I like a lot. It's U.S. Bancorp. I was sitting with a cost per share of $33.93. It's trading around 37. So, the fair value according to Morningstar is 52. It's got a really decent, payout. I'm sorry, a dividend. So, I'm liking U.S. Bancorp below 35. So anyway, hopefully that was helpful. If not, it was fun for me. So that's kind of what matters, right? All right, let's put me back up here. And let's go to, so Terry, hopefully that was helpful. And but again, I don't know what, I don't look at the whole market. I just don't have time. So all right, Zanati. Hey, Kevin, really liking your content here. And thanks a lot for that. That means a lot to me. I don't do this because I just want to sit here in front of a bright light and talk to a camera. I do it because I want it to be of value to you. And so, if you've got any thoughts on what I can do better, let me know that. I'm certainly open to that. Would love to hear your comments. But it means a lot that you're liking the content. So any thoughts on Vici? The payout ratio last year was over 100%, if I'm not wrong. Well, let's go first of all and check that out. I don't own Vici. I do have a couple of thoughts on Vici, though, that I'll share. But let's just check out their, I'm going to pull your comment here so that we can see a little better. They have a dividend safety score of 50. Oh, I'm on the wrong. There we go. So let's see. They have a payout ratio of 74%. And as we talked about earlier, the REITs are going to have a higher payout ratio than what we would normally expect from other companies. So 75% does not alarm me at all. So let's look at their dividend growth. It looks pretty good. I mean, it looks like they started paying a dividend in 2018. It was $1. They are somewhere around $1.50 now. So they're growing it by they've grown it for 4 years, and they've paid it for 4 years. And so first point I'll make about Vici is one of my rules is that I don't invest in companies that haven't been paying a dividend for at least 5 years. So I don't invest in Vici because of that. There's some other things, but I haven't studied them enough to really be definitive on it. So I probably won't share those, but it is not something that is on my radar because it's just not been paying a dividend for me long enough. It's non-qualified, which we know because it's a REIT. And so it's pretty consistent in its AFFO to payout ratio, which doesn't alarm me. 75% is right there at the average. So I would be fine with their payout ratio. I don't. I don't know. I'll just leave it at that. I'm not I'm not going to invest in Vici for several reasons. And maybe what I'll do is spend some time studying them so that I can be a little more clear and make sure that I'm not sharing something that's wrong. But, sometimes we have perceptions of things and we don't really know. And so I try my best not to share stuff that I haven't really researched. So. All right, next on the list is Morick. Do you know why Warren Buffett sold his stock of J&J and P&G? I do not know. He did not call me this time and ask. But, I would say that he's probably preparing to get into higher growth areas. As you know, a large part of his portfolio is Apple. And so, maybe J&J, P&G, they're getting to the place where they're consistent, but maybe his investors are looking for something more than that. I own J&J. I do not own P&G. J&J, I think, works well for my portfolio, and I'm good with consistent growth. And so, but maybe Warren is not, and maybe Warren's not making the calls anymore either. So that may be something to consider. So, oh, ex-dividend dad, my buddy. X to the what? X to the who? Ex-dividend dad is in the house. Welcome, my friend. Hope you are feeling better. I understand you've been a little under the weather, so glad you are here, and I'm glad you've taken the time to join the stream tonight. And how much does Morningstar cost per year? That's a great question, Russ. I think it's $149, or maybe it's $249. Let's let me go look. Maybe that's what we should do. I will just see if it tells it about us. Yeah, I don't know if I can find it really quick, but I know where I can find it. Give me just 1 second, because I actually paid for it. You know, because I don't have an affiliate link with it. So I will look it up very quickly. And those of you who know me know that I budget everything. So everything that I spend money on has a budget. And I'm actually pulling up my budget app to see how much I budgeted for Morningstar. And it's $21 a month. So if you multiply that by 12, it must be about $249, $250, something like that. So $21 a month is what I'm budgeting for that, Russ. So hopefully that's helpful. I'm going to get this off the screen. It's really a bright color. Man, there's a lot of stuff going on there. So let me get back to that. That's much better. Less distracting that way. All right, Jim. Trying to get back to you, my friend. There you are. STLA 0.50%. So it's a price to value of 0.5, meaning that it's basically half price, and it's a foreign annual payer. So yeah, that would be something that I typically don't invest in foreign stocks because of the tax complications. And it's not that it's that bad. It's just that I don't need the stress in my life. So, you know, but yeah, it says it's a half value. That would be the way to read that for sure. And that you own 150 shares of that. Great. Congratulations, my friend. Kevin, what is your opinion on getting a loan to invest? Miguel, that's a great question. And my opinion on that is I would not do it. You know, who knows what's going to happen, right? So, you know, and money's not cheap anymore. It used to be cheap. You could get a loan for a low interest rate. You can't do that anymore. The interest rates are much higher. There's a lot of risk there, and I would not take that risk. I would not take a loan out and invest in any circumstance. So hopefully I was clear with that. Jim Betts, I cut some shares of J&J because of concerns with the talc. That makes sense. I'm pretty sure when Warren found out, he followed suit. Yeah, so Jim Betts is saying that Warren sold some of his J&J shares because he found out that Jim sold some of his J&J shares. That could be very good. So ex-dividend says, stop it, Miguel. That is right, my friend. So we'll move on then. Oh, yeah, thanks for looking, Kevin. Yeah, absolutely, my friend. That's why we're here. We're here because we want to kind of look at this kind of stuff together. So we're just going to we're right at maybe 45 seconds from 60 minutes. I don't want to take too much of your time tonight. Plus, we got all of these folks in my living room making a lot of noise. Hopefully you haven't heard them. I turned the fan on, so maybe you wouldn't hear them. So let's see, Jim. Yeah, $249. That's right. $249 is what I paid. And so Jim also invests in Morningstar. So Jim, thanks for following up on that. Kevin, Miguel, better still to sell the wife's car and invest with those funds. That I could get behind, my friend. I could get behind selling my wife's car to invest in stocks. I'm not sure she would be as equally enamored with that idea, but I could get behind it. So Fast Eddie, get a second job if you want to invest. That's a great way to do it too. So you could get a second job. You could even really hone in on your expenses and drive those down and really go into just a real tight budget and squeeze some dollars out of your budget that way. Get a second job, sell your wife's car. There's a lot of things to do instead of borrowing money. All right, my friends, I think that's going to wrap it up for me. I really appreciate you guys joining tonight. And in the description to the video, you will see a link to Seeking Alpha, which has a great Black Friday deal. So if you're interested in that, if you don't have a premium subscription to that and you want one, take a look at that. And if you use my link, then you will actually send a few pennies to the channel, and it would help a lot. So I would appreciate that. And outside of that, I've got nothing else to add. I'm looking forward to this Saturday's video, because this Microsoft thing, I think is going to be very interesting how we handle that. So with that, guys, I'm going to let you go, and I will see you Saturday on a video and Monday on a live stream. Take care, my friends.